Are you thinking about buying a home, whether new construction or a resale, and it's in your plans for the future, but you're wondering about this thing called mortgage lending? It can be pretty mystifying to first-time home buyers. It can even be very frustrating and mystifying to people who are buying their second or third home. And that's mainly because mortgage lending, in the time I've been in this business, both mortgage lending and real estate, which is since 2006, it can be a game, and the game changes what seems like maybe sometimes daily. And so it is really important as you go down this path, because the financing of what you buy is going to really be a significant element in your success, whether a success of buying the home itself or the success of, did you buy it in the best way possible? So the financial well-being of your household, as you continue to have to pay that mortgage payment, really doesn't take you out of your comfort zone. It gives you and supports the experience that you bought the home for in the first place. If those are things that are on your mind today, you're in the right place, because today we're going to be talking about how to avoid the critical mistakes when you are going to get a mortgage, when you're looking for a mortgage lender, what you can expect in the process, and how to really make sure that you're in the lane that you need to be for success. And so today, first of all, let me say welcome to our video here. My name is Phil Martin with the Martin Home Team, and we do everything residential real estate in all the towns and communities and neighborhoods north of Dallas, Texas. And so here on the channel, Living North of Dallas, Texas, if this is your first time here, go ahead and subscribe down below, and then go ahead and ring the bell so you can continue to get updates as they come in on towns, neighborhoods, or topics like today, how to avoid critical mistakes in mortgage lending. And when you're looking at homes that would be in your budget, are going to give you the experience you want, the lifestyle you want in the towns and cities north of Dallas, Texas. And today I'm really excited because I have here a mortgage lender that I've known since 2003. We have been doing business together since 2006. And I can honestly say, as far as my experience is concerned, I've never met another lender that exceeds his talents and capabilities. There might be others out there that are as good, but I've never met one that's better. And that's Tom Pfister with Guaranteed Rate. Good morning, Tom.
Good morning.
Tell us a little bit about yourself, how you got in the game of mortgage lending and how long you've been doing that and where you're at today.
Yes, sir. I entered the mortgage industry in the late 90s. After graduating from Texas A&M, I entered the banking industry of Nations Bank. And from there, I developed into the mortgage industry itself. And through the years, we've seen a vast number of changes. Obviously, in the mortgage world, it seems to be changing every day, but I've been doing it for over 25 years. And
25 years.
Yeah, 25 years.
Time.
Yes, sir. And I'm currently with a company called Guaranteed Rate. Guaranteed Rate is a national rate leader in the industry. And we do anything from excellent credit to money down to even if you got fair credit or no money down. Guaranteed Rate also specializes in veterans and a vast array of products out there to help you obtain a mortgage to buy a house.
I appreciate that, Tom. And again, thanks for being here today. So first question that's on my mind that I think the viewers would like to hear about is, when in the process should people reach out to a mortgage lender? Because I get asked all the time, I don't want to go now. I'm not going to buy for 6 months. I'll ruin my credit. I'm working on my credit. I really don't think I need somebody to do a hard pull, et cetera, et cetera. In your mind, when is the best time for people to really start to talk with you?
Well, whenever you're starting the process of looking, it is important to get started right away. Even if you're not looking to purchase for 6 months from now, it's better to have the credit and everything evaluated today just to see where you are in case there is an issue that comes up. There may be something on your credit that you're not aware of. It could be something as silly as a medical collection that you thought your insurance company was covering, and then all of a sudden it's there, and that could stumble the process, whether the approval or even the rate. And so it's best to get it done, handled up front. And so that way we have time to get it fixed in order to purchase down the road. And also, it also helps set realistic expectations as far as where the purchase price and payment will be, what cash to close, how much you really need, because there's a lot of misconceptions as far as how much you think you need for a house or even what the payment is, because you're looking at some online calculator that isn't familiar with the Texas taxes and insurance out here. And that's another reason why it's important to work with a very experienced real estate agent who's very familiar with the area and knows what the taxes and insurance are going to be as well. Because when they start hearing flags as far as, hey, I want my payment to be $2,000 a month, and you're looking at a $500,000-$600,000 house, then that's where we can set the proper expectations up front.
I could not agree more. It's about how many times when people come to you, do you find things that surprised them? What percentage of the time, whether it's first-time home buyer or not? How many people get surprised by, oh my gosh, didn't realize that?
On a first-time home buyer basis, it's a super high percentage because they're either expecting a lot of money needed, or they're expecting their payment to be a lot less. They're just not familiar. Texas does not have a state income tax, but we do have a high property tax. And so the taxes that somebody may have been paying in another state may be a little bit different than what you're paying here. And the property, the monthly payment on a mortgage seems to be a little bit higher. So it's best to have that set up front. If they bought a house before, they're a little bit more familiar, but it's still important to make sure the numbers are accurate.
A couple of things you've said, not to get surprised, to understand what closing costs are. And when we talk to clients, we'll say, have you ever been blindsided in a process? And you really think you're near the end, and then you get blindsided. And that's finding out things you weren't aware of. The number one thing that we see is that people getting blindsided on the financial side because they didn't look far enough in advance with the mortgage lender to make sure everything would go smoothly. And so, like you said, with first-time home buyers, it can be a fairly high percentage. And the other thing is, you were talking about closing costs. We refer to that sometimes as people say, I have this much for my down payment. And then you say closing costs, and they're thinking, well, it's a nebulous term. So we say out-of-pocket expenses. So you've got closing costs, or you've got a down payment, but then out-of-pocket expenses can actually be more than your down payment in many cases, especially with first-time home buyers putting small amounts down. So avoiding the blind sides, and then understanding your cash to close, which is down payment plus out-of-pocket expenses, not getting blindsided by any of that. Working 6 months in advance, what does that do to the credit if they look 6 months in advance? Is this going to hurt them? Just quickly.
If their credit is good, no. And it's not going to really have, an inquiry is not going to have that much of an effect on the credit, especially if you're making your payments on time and you have good credit. If your credit is borderline, it could have a little bit more of an effect. But even then, it's still better to know where your score is, because a lot of people look at their credit online, which is not an accurate credit score versus what mortgage companies pull.
And we'll get to that in just a moment. Let's say that is a nugget that you do not want to miss in this video. So if you're watching, you have to stay at least to I recommend to the end, because you'll learn so much. But when we get into the credit section, a lot of people get surprised by that. So I appreciate it, Tom. So at least 6 months in advance is good, because if you need time to adjust, you have time, right? So if I'm thinking about looking at buying a home, I'm 6-9 months out, I might say, okay, fine. I need to look at my credit profile, my financial profile, to make sure that we're on track. And if I may have to make adjustments, I can. I have several months to make those adjustments for success. My next step would be, okay, how do I choose a good lender? What would be the criteria that you would share with people?
Once you're working with an experienced local real estate agent that knows the area, he's going to have recommendations of people that they use, that they've worked with in the past. And that's always going to be the best option. Going online, not a good option. You want to find somebody that has experience, that has a relationship with the real estate agent you're working with, and that is local, that's familiar with the area, because you want to be able to get an accurate assessment and accurate payment.
Are you saying that it's online is... What about online is not good? Is that has to do with not being local, not being available after 5 or on the weekends? Or can you share a little more on that?
Yeah, it's all above. It's the quotes you give may or may not be accurate. You're dealing with somebody who's probably not very experienced and may be able to give you the best product. If you're a first-time home buyer, they may not be familiar with first-time home buyer products like bond loans. If they're not in Texas, they may not be giving you an accurate payment when it comes to taxes and insurance, and what fees are typically paid by the sellers and what fees even exist on a loan. Because title companies and title fees, like for example, in other states, you have transfer tax. In Texas, you don't. And so there's certain closing costs that don't even exist in Texas. And so that becomes important. And then accessibility, if you're dealing with somebody local, or you're dealing with somebody that your real estate agents work with, such as myself, we basically just have our cell number. And so we're accessible, 7 days a week and after hours. And if we're not available, you can always text us and we respond back. And so a lot of times you're looking at houses after hours. You're looking at houses on the weekends. That's when you're going to have questions. And you're dealing with somebody online. You're going to be dealing with somebody at 9 to 5 going through a 1-800 number, and it just becomes a little bit more complicated.
I'm glad you brought that up, because I cannot tell you in our experience of a decade of real estate service to our clients, how many times we've had to reach out to you or other lenders on a Saturday, on a Sunday after 6 or 6:30. We're in the middle of a heated negotiation and we have to have an adjustment or some letter adjustment from the lender. And you hear crickets because the lender is somebody who works in an office somewhere in Michigan at 9 to 5, as you said, not even the same time zone. And I agree with you. It's something that should be seriously considered. Accessibility equals service. Because when you get down into the buying process, timing is just about everything. When you put offers in, the other listing agent absolutely will call that lender. And if the lender doesn't pick up, sound knowledgeable, I know with my experience, I ask questions and I'm really gauging, were you accessible, number one? And if I can talk to the lender, I'm gauging experience. So I know the questions to ask. And if I don't hear experience, I get nervous, because lending can be complicated. And the lender, like yourself, you've got to be pretty agile in knowing how to, I always call it thread the needle. I don't know. I like to say the rules change in the mortgage lending game. It seems every day. Can you comment on, not that it's an incredibly complicated and you need a PhD, but how important is experience? Accessibility, we talked about, but experience. How important is experience when you're choosing a lender?
It is extremely important, especially depending on the type of profile, the borrower that you're dealing with. If you've got somebody who's got credit issues, it's extremely important to know how to get around that. If you're not a standard W-2 salary employee that fits in a perfect box, then that becomes a whole other set of issues. Self-employment becomes something that becomes very critical.
Let's talk about that real quick, Tom. You just brought up something that my bells and whistles went off in my head when you said self-employed, because we're self-employed. We help a lot of people who are self-employed. How different is the lending process, in a nutshell, between someone who has a W-2 paycheck job and a self-employed person?
It's night and day. And somebody's a W-2 salary, you get the pay stub and it's a set salary. We know what it is on the 1st and 15th, and we know what their income is, and it's pretty straightforward. When you're employed, you can follow a whole other set of guidelines. And after the crash in 2007, the mortgage industries took a big knee-jerk reaction to income and making sure that we can verify the income and how they verify it. But there are different ways that you can assess it. When somebody is a 1099 Schedule C type of filer on their taxes, there are certain income deductions that we can put back in as income. Then there are certain programs that we can use that allow us to use maybe just 1-year tax returns. Or as a standard, you got to average the last 2 years. So if you're going by the book, you're averaging 2 years of tax returns, and you may have had a bad year, but then people say, oh, well, I'm having a good year this year, which is great. But then when you start averaging it in, the income is going to be a lot less. But there are programs that can work around that.
And without going into all the gory details, because they can be, if someone is self-employed, because you and I have worked on cases where we've had to it took 1 year to 2 years to prepare the buyer to be successful, because they had to go back and refile taxes with their CPA to be eligible to buy. And then after they buy, they could go back to their normal ways of doing taxes as being self-employed. I think it is night and day. Given that, if someone is self-employed, or just as important, if you're W-2, but you have a business on the side that you have been claiming deductions for, red flag, in terms of you need to plan and prepare ahead of time, right? How far in advance is a self-employed person?
That was even more critical to look at as far in advance as possible.
Right.
Like you said, so we can plan ahead. It says, okay, on the next year's tax returns, we're going to have to, show less deductions potentially to qualify.
Would you say 12 months or 18 months? 2 years?
The sooner the better to do it. If somebody's looking, especially if they're looking at new construction, that's whether it's 12 months or whatever the time frame is, you want us to take a look at it so we can better prepare for time when it's time to fund the loan.
So in other words, as soon as you even think you want to buy a home, It's just like in your business, you're planning and preparing 3 months, 12 months, 18, 5 year, maybe even a 5-year plan. You should look at your home purchase that way if you're self-employed. But here's the key to that. I can say all the things that you've been saying, you are just touching the tip of the iceberg on how complicated it can. The more complicated the business, it can be very complicated. And experience on a lender at this case, I've seen working with you, people coming to you after they went to other folks, just couldn't figure it out. And amazingly, you're like, we need to move this, move that, and you figure it out. Not all lenders are created equal, and experience matters. And let's just touch base again on, you've been doing this since 2000, right?
In the late 90s, actually.
Late 90s. Oh my gosh.
And as people who are self-employed, they even sometimes have multiple businesses. That's where it really gets outside. And I've seen it where they have 10 to 15 businesses. And then you're dealing with not only personal returns, but you're dealing with multiple business tax returns, and it gets extremely complicated.
Okay. So when should you go to the lender? Early on? 6 months if it's W-2, a year, 18 months if you're self-employed. What should you look for in a lender? Accessibility, experience. I will actually provide a list of questions sometimes to our clients to ask the lender they want to talk to, and just see what the response is. And so the next thing I want to really pick your brain about is, there's a certain mindset with a lot of people who are going to do a pre-approval, go through the pre-approval process with a lender, and they'll think they don't understand how complicated this game is and how much information you really need from them. And then they'll maybe hedge their bets a little bit. They'll tell you 3/4 of the detail you're asking for, but not all of it. Or they may be a little standoffish, or just because some people, they just don't trust us if they haven't been working with us for a while. How important is it for the mindset of when you're talking with a lender? I always tell our clients, it's talking to the doctor. You better tell them what hurts and where, so they can make the proper diagnosis. How important is it that when people come to you, because they're afraid they're going to get hurt on the credit pull, or they're afraid to say, yeah, I had this bad thing happen. Bad things happen to everybody. So I tell people, but they're hesitant to tell you everything sometimes. How important is it in the lending process when you finally choose a lender to really just, I like to say, open the kimono? Here's everything.
It's very critical, because our primary job is to get you approved. That's what we're there to do. And a lot of times it's almost like putting a puzzle together. I got to see all the pieces. And you're trying to if you're trying to hide something, mortgage industries are so detailed right now. It's going to come out, and it'll eventually come out. And the last thing you want to do is have it come out a couple of days before closing, or 2 weeks before closing, or after you've already spent money on inspections and appraisals and everything else. And if you tell us in the front, we might be able to get it addressed or fixed or handled before it goes through the process.
Right.
And that's the way the best to be able, just be upfront with us and tell us everything. We don't want to have a gotcha down the road, because on a pre-approval, it's preliminary, but it's not as detailed, where we could miss some things. And so if you forget to tell us, oh, by the way, I'm paying child support, and then we see it garnished on your pay stubs, it's going to come out. Something as simple like that. Or I'm paying IRS tax liens on taxes that are a long time ago, it's going to show up on your bank statements. There's going to be a way where it's going to come out, and we can address those things up front if we need to. You and I have been involved in circumstances where that's happened, and it's like a gut punch. Literally, when Tom says, when you say everything will come out, everything in your financial hemisphere, your world will come out, and they will double, triple, quad. They'll keep checking all the way until the day before close, sometimes all the way till the very last minute. And you're giving people guidance on how to stay safe on the path to success. And sometimes consumers may not tell you everything, or sometimes they'll get off the path and do something like go and buy a car, get some furniture the night before. And what happens when they don't follow the good advice of here's how to stay safe? Because once you sign a line and they give you the money called funding, there's no takebacks. No one will ever ask another question about your financial bubble, ever. It's yours and you're responsible. But before then, they will go to the bitter end to make sure that everything, because they're giving people $500,000, $750,000. Of course, they're going to check and make sure nothing changes up to the last second.
And what would you say to how important is it to stay on the path that the lenders put you on until the very end?
Oh, absolutely. Yes. You can mess it up at the very end if you say I'm switching jobs and didn't tell us at the last minute, or like you said, I'm about to trade in my lease or a car, and the payment, it may or may not, but it's best to be upfront with us so we can make sure that there's not an issue.
Yeah. Talk about a gut punch and a blind side. But here's the thing, in those situations, you and I, we're not buying the house, Tom. It's the consumer that was thinking that I've gotten this far and I didn't divulge these facts, or I got off the path a little bit and jumped back on because what's going to happen? And really what happened, the gut punch is really not to us. It's to the person who wanted that home. Because can you imagine having all your stuff on a truck ready to move, and at the last minute, because you have a new lease on a car, everything is stopped. And
that's
don't do it.
Of having an experienced real estate agent to be able to look for flags like that. I can't tell how many times where the customer did do something like that and said, I told my realtor, but they didn't tell us. And if you have an experienced agent that's out there that can know these flags, they'll say, whoa, let's bring attention to the mortgage professor, like mortgage loan officer, to be able to say, hey, this potentially could be an issue.
Absolutely. So let's jump into the next section. So as people begin to fill out a mortgage application and they're going through the process, there's really 4 things that, as a mortgage lender, 4 areas in their life that you're going to be looking at. And so at a top level, I just want to go through the highlights of what those 4 areas are to give people a heads up on what they can expect walking through the process with a professional like yourself. So the first area that you'd be looking at, we might call the identity of the person. What are you looking for there in terms of who they are, where they work, and what they do?
We need to make sure they are who they say they are, but that ain't kind of fraud. And they go through enough information where they're going to verify the identity of the person. Then from there, we're obviously going to verify their credit, their employment, their income, how they're bringing in income, whether it's W-2, self-employed, or even retirement or Social Security, whatever it may be. And then their assets, what they're using for the down payment and what money they'll have post-closing.
So you just mentioned the other 3, in addition to the one of identity of who they are. Some people will say, oh, I haven't worked for 6 months and I'm scared. I just got another job. I got laid off, or I've been at school, or can I bring in other people? Can I have someone with me on the mortgage, but that's not going to live there? In that nutshell, you're really identifying who's going to be on the hook for the money, right? And what are the general, I guess, ways that can look?
Yeah, we're looking as far as on the application itself. You're obviously going to have the primary borrower. And then if they are married, we need to get their information, especially Texas being a community property state. We're going to want to make sure we have the spouse's information as well. And then if they need a co-signer, if it's mom, dad, whoever, you can actually do that. There's a common misconception that you only have 2 borrowers. You can have as many as you want. And so we just closed recently a 4 borrower.
And then they don't have to live in the house. They're just...
Yeah, it's considered what's called a non-occupying co-borrower. And that's where mom and dad can actually, or whoever, I'm just using that as an example, can actually co-sign, and we can use their income and credit for help qualifications.
And let me say that when it comes to types of loans, there's all types. And that's, again, why you want to go to an expert in the lending industry. But if you're going with an FHA or VA and you are married and you're considering maybe only one spouse on the loan, or maybe if you're not married, but you've been partnered with somebody for years and you're going in on a VA loan, you need to talk to the lender early, because there's going to be some interesting rules around how income, debt, and who can be on the loan is going to be handled. Would that be a fair statement?
Oh, absolutely. Yeah. And any federal loan, whether the borrower is on there or not, we have to include the spouse's debts. And so if you've got you're saying, oh, I put the cars and everything in my wife's name, but I'm not going to put her on the loan, it doesn't matter. It's community state, and we got to add the debt. And
if you're going with a VA loan, I'm a veteran. You've done VA loans. I think you've done a VA loan. Maybe done a VA loan. You've done tons of VA loans for my clients. I used mine 3 times. It was before I came back to Texas. But I've been in experiences with you where everybody thinks they understand the VA loan, and when you really start to chat with them, they don't. Even veterans don't really sometimes understand the difference between eligible and qualified. They're two different things. They think that the VA is giving the money, but they're not. And just, I can't stress enough, and maybe you can shed some more color on this, Tom. If you're VA or US, these government loans, FHA is a little more common, but how important is it to talk to a lender with really deep experience when it comes to these types of loans? And people who have a website that have VA or veterans in it, they're not from the government, right? Most of the time. Shed some light on that.
Yeah, absolutely. Each program is going to be unique, and you got to look for the potential pitfalls and things that may occur in whether it's VA or USDA, the eligibility, making sure that you can qualify and what money you can actually get from those government programs, and whether it's even the right program for you. But yeah, Veterans does not lend money directly. They do guarantee it, but any lender out there has access to it, whether it's Veterans United, USA, or Navy Federal. Those are all just banks and third-party entities, just like Guaranteed Rate. They don't have any special program or anything. In fact, actually, a lot of those companies end up doing is they take the VA guidelines and then they turn around and add their own guidelines on top of it. It's called an overlay. So it's additional guidelines on top of VA. And a company like Guaranteed Rate and other companies will take VA guidelines and just follow them exactly, or USDA. And so they just follow the pure guidelines itself.
And so here's a little tidbit for our veterans in the audience. If you are the widow of a veteran and you haven't been remarried, you can use the VA loan. If you have a house currently with your VA loan, you could possibly buy a second home, a new primary residence with your VA loan. There's all kinds of really cool things you can do with that VA loan. So if that's the case, reach out to a very highly qualified lender in the VA space like Tom Pfister, and you may be surprised at what's possible. Let's get into the next thing. So there's identity, and we've just talked about a bunch of stuff in that, but let's go to credit. How important is it that the credit score that you're going to depend on as a home buyer is one that was pulled by a mortgage lender and not one you got off the internet?
It's critical. Mortgages are nationally regulated, which means whether you apply with us or you apply with whoever, if it's a mortgage, you're going to pull a very specific scoring model called the FICO 2 scoring model that is uniform among all mortgage companies. And it's going to be different than what you're going to pull if you're applying for a credit card or a car loan. To give you an example, if you walked into, let's say, a Wells Fargo bank and applied for a car loan and then turned around and applied for a mortgage with Wells Fargo, you will have two different scores, even though it's the same company. It's that we use an entirely different scoring model that may or may not be the same as your, it's called the Advantage score, but your other score that's being pulled.
Or a simple FICO.
Yeah,
no,
I've seen it where it's higher and I've seen it where it's lower. They just take different factors associated with it. So it's best to make sure a mortgage person is actually pulling the credit.
And here's a little secret that very few people really know. In the mortgage lending industry, you always have three scores, right? Three credit scores, one from TransUnion, Equifax, and right? In the mortgage, when getting mortgages, which of the three scores do they use, Tom? The highest, the lowest, or the middle?
The middle.
And when you look online to see your score at the bank or Credit Karma or wherever, you always see the high according to their scoring system, right? They never show you that middle one. They always show you the high score mostly because they want to impress you a little bit. This is why it's so critical that you call someone like Tom and say, please pull my credit. I'm planning to buy a home. What reality is, because obviously if they're showing you the high score on the internet and your mortgage lender is going to show you your middle score, it will almost invariably be something you weren't expecting. Right, Tom?
Absolutely.
And so when people come to you with a score, what percentage of the people that come to you need some adjustments on that score, the middle score, right?
A large percentage, because it might be something as simple as, like we discussed, I said earlier, a medical collection may be on one bureau. When it costs money to report to the credit bureau. And if you don't pay a particular doctor or is not paid by an insurance company, they may file a collection on one of the bureaus, not all three. And if you have to be checking just one bureau or the high score only, you're not going to know about what else is out there. Or maybe it's already reported to two. And it's not even just that. It could be anything. It could be you missed a minimum payment due on a credit card that you never use, or there's a lot of blind sides that could come up.
And I always say that the mortgage lending is a game that changes every day. That's why you need an expert like Tom. But credit scoring is so wildly misunderstood. And just the slightest tweak sometimes can result in improvements. And what would you say, Tom, of the people that are trying to get a mortgage that are just out of the money, so to speak, the better credits, the better interest rate, because the higher your score, the better your interest rate. What percentage of people that need a little bump up in that credit do you help just through your discussion and dialogue and giving them guidance without, there's no fees associated with it, but just guidance on how to behave in a few different ways or do a few different things over a couple of months. And next thing, your interest rate just improved incredibly or 20, 30 points. And all of a sudden you can get the loan versus not get the loan. What percentage of the people that you work with would you say that you go through that process with?
It's actually a pretty high percentage because you deal with, not only do we just give advice as far as what you need to do with credit, but we actually have what's called a credit simulator that we run the credit through that gives us what if scenarios. So you pay this off, or if you do this, or you pay this down. A lot of people say, oh, I need to go pay this credit card to improve my score. That may or may not increase your score.
Right.
Or it may have no effect. It just depends on the rest of your profile. I've seen it where they pay off a collection account and the score drops. And that's not a good idea. But at the same time, a lot of times you pay off a collection or a charge off and your score goes up, or you pay down. Revolving debt is a big one that affects the score. But it's best to run it through the simulator to be able to tell us, to make sure we're giving you accurate. Instead of shooting blindly, let's make sure we're going in the right direction.
And if there's two borrowers, two spouses, you have to use the middle score of the lower middle score of the two, right? And so sometimes the lower middle score of the two goes up, and now the one who had a higher middle score to begin with now has the lower score. And so you may be hopscotch up the ladder a little bit. But for sure, I've seen it so many times where people work through the process with you and people like you and they get a better deal. But not everybody can be helped through using the simulators and just guidance. Some people do need true professional credit repair, but those people tend to probably already know that in advance.
Yes, I'm not going to go through and file disputes or do anything like that. But what I'll do is be able to say, okay, we need you to go pay down this credit card by $300, and then give me a letter showing that it's been paid down, and I can try to rescore it pretty quickly for you. But as far as if you need things removed, that's where we'll have to refer you out to some kind of credit repair company.
What happens when you check their credit? Is their score going to go down? Is it going to be affected? What's the difference? People hear the terms hard pull, soft pull. What are people's options when they come to you? What's going to happen to their credit score that they've been trying to keep good because they're going to buy a house?
Well, an inquiry doesn't affect the credit as much as you think. It really doesn't affect that many points. And if you're really wanting us to do a true pre-approval and evaluation and be able to run the credit, we need to run a hard inquiry. And that's always going to be the best. It's not going to have a major impact. And then also, once you have one mortgage company pull, you can have multiple mortgage companies pull within a 30-day period, and you're only going to get hit once for one inquiry. And so if you've already checked with some online company or your bank, you can still come to us. And at that point, it really has no impact already because you've already had your credit pulled. Just try to make sure you get it done within the 30-day period.
And for really contentious items on a credit report, and we're in a bind and we need to get a change on that credit report fast, because changes on credit reports take 30, 60, 90 days sometimes, even just through good adjusted behavior. What is a rapid rescore?
Yeah, that's what
would that be used?
Yeah, and that's what I was referencing earlier. As far as if we needed to pay down, let's say we need to pay down a credit card by $300 to boost a credit score up 10 points. All right, just to get that qualification or a better rate. We go ahead and pay it off, get us a letter from the credit card company saying that what the new balance is. You send it to us, and in about a week process, we can rescore that one account, and the score will adjust based on that one change. And so whether it's paying off a collection or paying down a credit card, we can accelerate that process and get it done in about a week time frame.
Perfect. So we've talked about identity. We've covered the credit briefly. Now, the third criteria or the third area that you're going to be exploring with people are their assets. What are their assets and why are they important?
We have to verify where the money comes from for the down payment and closing costs.
So assets are money?
I'm sorry, say it again.
Assets is their money? Is their 401k? Is it their?
It's everything. We look at their checking savings. You can use your 401k.
You have to.
We don't.
You have to show all your savings accounts.
It's best to show as much as you have in order to cover the down payment and closing costs. And then if the credit is needed, we might need what's called a reserves, which is money post-closing to make sure we're not like liquidating everything you have.
Would that be money you take or money that's just in their account and the bank is aware that they have extra assets?
We just need to be aware, just aware. Yes, sir. Yeah. Things that you can't use is going to be cash on hand, cash in the mail on a mattress or something like that. Those are things that we cannot be able to use as an asset. We have to be able
What about cash in my bank account? That's my cash. It's in my bank account. Why can't I use that?
If it's in the bank account and it shows as a balance, it's fine. But we're going to get bank statements and all of a sudden we see a $10,000 deposit. We're going to question where that comes from.
And how far back do you go to question those deposits?
60 days.
Okay. So if you look at my bank statements and I have a $20,000 deposit 5 days ago, I'm going to have to do some splaining. As
correct. They're going to ask for what, and if it comes to find out that it was cash, then we're not going to be able to use it. It would have to be back.
Unless I can explain where it came from and you agree with the explanation or you're okay with the explanation.
Yeah. Cash gets really complicated. If you have cash, deposit in your account right now. Don't go ahead. Don't even wait.
So if I show you 2 bank statements and I deposited 3 bank statements ago, it's a non-issue.
Correct. We won't even use it.
Okay. So we call that seasoning your bank statements for 60 days.
Yes, sir.
And that's another reason, credit plus assets being seasoned. Another reason why planning is critical and you know in advance where things need to be. I'm sorry for interrupting, but go ahead. These are incredibly important nuggets that we're rolling out on the table for people in this process who really want to make sure that they're successful and avoid these pitfalls.
Yeah, and if you need the assets, you can also even get money from your parents. You can do a gift. And so if you don't have the money to close, you can get money from other sources. You just need to let us know where it's going to be coming from. So like that $10,000 deposit, let's say it was from mom and dad, that can be done, but let's make sure we can document it.
Yeah, I always tell people you can get money from a lot of places, but it better be vetted through your lender. If you have 20 cousins and each cousin is going to give you $1,000, you're in the money now. Because it has to be like a blood relative, I think, to give you money as a gift.
Yeah, and then we get a copy of we get a gift letter and we get a copy of the check showing the deposit, which basically we create a paper trail. And if it's HA, we got to get a copy of the statement from the donor as well.
I get comments a lot of times, people going, man, they're asking other people in my life for their bank statements who gave me money and blah, 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 blah. And they're not happy about it. And people who gave the money may not be happy about it. But here's the bottom line. If someone were to ask you for $500,000 and you're trying to figure out if they have the wherewithal, the assets and the income to pay you back, and all of a sudden they've got money, you're going to want to know where it came from and was it legitimate? Yes, you would. And so the bank does too. So don't be surprised when experts like Tom are saying we need to, and his staff is asking you for different things to basically verify a paper trail. Because this is the golden rule in mortgage lending. He who has the gold makes the rule. And Tom is there to make sure he knows the rules. He didn't set them up, but he knows what they are. And better than anybody I've ever seen. And his staff knows what they are. And so that's why they're putting you on a certain road, a certain path. So when you get to the final decision maker called the underwriter, they go, oh yeah, everything has been laid out perfectly. It's on the right path. There's nothing that falls left or right, hopefully. And away you go. And so all the things we're talking about, making sure that all these questions that you're going to be asked are answered, and that you're incredibly open with the lender is really so they can make sure you are successful. Because everybody needs to be adjusted coming through this system. I would say vast majority of people. But if you make the adjustments before the underwriter, the bank sees it, it's not a big deal because the bank's not going to see it until probably about a week before you want to purchase the home. And at that point, if something is not there, that's when the fly is in the ointment. So when it comes to assets, if you have a lot of cash on hand, how much or a lot of assets on hand, are there other things you now have access to in terms of being able to buy your interest rate down or create cash by raising the interest rate? Are there In a nutshell, without going through all the explanations, because they can be detailed, a person like an expert like yourself who looks at the situation, I always like to tell people there's so many different ways to get the out-of-pocket expenses and the closing costs and the thing that happens at close and your interest rate to line up. It's just so many things, from asking sellers for money, for getting cash incentives from builders, to discount points, premium points, gifts. There's so many different ways to put, I think you've mentioned earlier, Tom, the jigsaw puzzle together, right? Oh. And when it comes to assets, I think it's probably one of the most flexible and places and most creative places you can get to help people if they're talking to someone who knows what they're doing and is willing to do it. Because some lenders just frankly don't like to go through the work it takes to thread a needle. They'll just look for the needles that don't need to be threaded. They can just drive through with a truck, and they won't take on files that are difficult. Can you comment on that?
Yeah, especially when you deal with assets, it becomes a lot of different ways you can get a loan approved. A lot of people think just put more money down to get the approval. If it's another issue, you might get more bang for the buck to pay off debts versus putting money down. Or you might need to have to buy down an interest rate. Or maybe you don't
use one program versus another.
Correct. There's all types of options out there. That's really what creates the biggest where we have to be creative with the program. If you've got money, that opens up doors for a lot of different programs. If you don't have money, then we need to look at other options. And there's even down payment assistance programs out there that maybe somebody's not a veteran or can't buy in the USD area that you could potentially go in if they don't have the money. And we have to use that to be creative to get them approved.
And in Texas, there's probably there's 6 flavors of down payment assistance. Give us a brief overview of what is this thing called? First time home. People call me and say, "Is there a first time homebuyer program that'll pay for my down payment?" And I say, there is, but you need to talk to Tom or a very experienced lender, especially on these.
Yeah, there's a wide range of down payment assistance programs out there. If you're a first time home buyer and you make certain income that's below what the state has considered the median income for the county, then you could qualify for money from the state of Texas to help you with your down payment and maybe even get a preferred interest rate. And then even when you get the down payment assistance, there's always 2 options, whether you get it where it's forgiven, it's basically just free money, or is it money that they quote unquote give to you as a gift, but you're going to repay it back when the home has to be sold. And so It basically creates like 100% financing. And then if you're not a first time home buyer, or you make maybe a little bit more money, there's still programs out there for free money from the state. And so the interest rate may be a little bit higher, but if once again, the starting point is how much money do you have to bring to closing? And if that number is lower and you need it to be as low as possible, you don't even have to be a first time home buyer. You can still get money from the state. Now, if you make $250,000 a year and you don't have money, then there's not really a program, but they're designed for those generally. And if you're buying in the deal who make less than $120,000 a year, that's pretty much the top end. Once you start making more than that, it becomes harder to get those programs.
Okay. That's good information though. Down payment assistance programs to go through the process 6 months ahead of time would be a great time to plug into those. But if you only have 30 days or 60 to buy a home, it can still be done as well. Tom?
Oh, absolutely. Yeah, we've done it where they've been talking to another lender already in contract, and we've switched them over and get it done within a couple of weeks.
Okay. And let's jump to our last category, which is we just kind of transitioned into it, was income. Assets are different because it's money that you have already. It's yours. Income is money that is flowing to you on a month-to-month basis. And so debt to income, it's this big term, DTI. How important is income and the other 3 categories of identity and credit and assets? How does it all come together in debt to income?
Is equal. Any one of those categories can cause a loan not to get approved. And income is just as critical. If you don't have the right debt to income ratio, you're not going to qualify, or it's going to limit how much you do qualify for. If your income is low, or you just have a lot of debts or whatever it may be, it's not that you don't get approved. You're just going to get approved for a certain price. It may or may not be what you were wanting. And then making sure we're using the right income that we calculate, we have to follow the rules set by Fannie Mae, Freddie Mac, or whatever government program you're doing. We got to make sure that you're fitting within that box to qualify.
Yeah, what comes to mind when you say that is W-2 versus self-employed. W-2 people say, I'm switching jobs, so I guess I can't. I've heard I can't buy for 6 months. I'm like, you can buy before you switch jobs as long as you talk to the lender and we have letters and we're waiting on, and the close of your house is at the moment we get your second pay stub. It gets real detailed, right? A lot of things are possible. But if you're self-employed, to figure out income, it's not that easy, right? Or if you have a business you're running on the side and you're writing off all kinds of costs, but you have this W-2 job, and you're only looking at the W-2 job thinking, I can easily buy a house. You need to talk to an experienced lender, because the income calculations and your debt to income may surprise you, because the bank has certain rules on calculating it that you may not be aware of. Tom?
Oh, absolutely. Or they say my business is doing great now, but you haven't filed the tax returns for, let's say, for 2023, and that's what your business is doing good. We can't use it because it's not filed yet if you're self-employed. So that's where the importance of looking at it that way. But as far as the new recently employed relocations, a lot of times they haven't even started the job. As long as we get the letter, there's ways to use that income if they're relocating from another state. And just get with us and we'll let you know what we can and can't use.
Income, very important. So credit, we went through or identity, then credit, then assets and income, and kind of rolling it all together, going in advance, making sure the situation, you have professionals that are walking along with you. As we wrap it up, there's so many moving parts with the financial piece on the mortgage. I know that we, on the real estate side, we do what's called a seller net. Tom, how important is it that the seller net, the realtor is doing, matches up with the financial analysis and pre-qualification that you've done is?
Oh, it's critical, because there's a lot of times having an experienced agent that can give you the accurate information can affect everything. If we're expecting X number of dollars on the sale of a house, and in reality, once it gets to closing, if the number is different, it could affect everything and can put the loan into jeopardy.
You can stop the show.
Absolutely. And then also just listening also for additional flags, having the experience of an agent to be able to listen for the flags that they're self-employed, but they're paid W-2 and they think they're a W-2 employee, but then all of a sudden you say, they're not W-2. He actually owns that business. And having an agent that knows what flags to listen for and then to relay it to us is very critical. Having the assets, making sure that hey, by the way, Tom, this home that we're looking at, the HOA dues are $300 a month. Having those things to be able to bring to our attention that can affect the deal is extremely critical.
And so it's so important that you have a lender and realtor relationship that is like seamless. And so pick your professionals very carefully and make sure that they are communicating and it's seamless, because getting communications from the lender throughout the process, I cannot tell you how critical that is, because there's about 4 or 5, maybe 6 different processes that are milestones through the lending, right? And that's really signals things to the realtor that we're in the next phase, right? Or we're coming up to it. It's just all important to get you across the finish line as the consumer, as the home buyer, as the home seller. We have covered a ton of information. And so people watching the video might be saying, okay, I need a good expert lender. I need a good expert realtor, et cetera, et cetera. Why would someone pick you, Tom? And what's the advantage of using you if they were going to go through the process? Let us know what that is. And then how would they contact you, Tom?
Yeah, basically, we offer the full gamut of products. We're a one-stop shop. So whether or not you're looking for somebody who's got a very competitive rate, Guarantee Rate is one of the national rate leaders in the industry. But if you've got some potential issues on your other end of the spectrum where you're needing to get money from the state of Texas and you don't have money for down payment, and you need to get down payment assistance loans, we do those as well. There's a lot of lenders who say they do them, and then they'll tell you, oh, no, you just don't qualify, because they don't want to do the extra work or because they're not familiar with them or for whatever reason, but we're not afraid to do those. Or if you've got credit issues, we go down a little bit lower than a lot of the other lenders do when it comes to credit score. There's not a buyer that we're scared to do. Even if you're self-employed, we can get real creative with you. We even got bank statement programs if you just absolutely don't show any income on the tax return. So we try to look at any option out there to get you approved. It's not a question of just coming back saying yes or no, but it's saying yes to get you into the right program, right product, or no, but this is how we can get you approved down the road, or this is what you need to do to get you approved.
So FHA, VA, conventional are types of loans that don't have any government strings to them, if you will.
There's all kinds of different options out there. And then I try to make myself accessible. My cell number is the only number available. So if you need to get pre-approved after hours or on the weekends, I'll be available to be able to assist you. 100%.
What is your cell phone, Tom?
My cell number is 9300-8246. My email is tom.pfister@rate.com. And you can reach me anytime if you have any questions. Even if you're working with another lender already and you just want to have a second opinion, reach out to me and let me give you my opinion and I'll shoot you straight.
And do you have Spanish-speaking loan officers on staff that can under loans or that can process loans?
Absolutely. We do have Spanish-speaking loan officers. So if you need that particular type of loan officer, just let us know and we'll be able to assist you as well.
So you work with TIN numbers and that whole gamut.
Yes. If you happen to have a borrower that's looking at that needs some assistance with not only the language, but also they may not have a social security number and they're using a TIN number or whatever, or they're a DACA buyer, then yes, we can assist them as that as well.
Okay. It sounds you guys are very well rounded and you're checking all the blocks. And I can say after at least 2 decades, we've been knowing each other, working together, et cetera. I would say absolutely. If you're thinking about it, Tom Pfister and Guaranteed Rate should be in the running as one of your top considerations. And you said something there, Tom, call us as a second opinion. A lot of times we have people looking at new construction and we'll go to the home builder and they'll say, if you use our lender, we'll give you a little more incentive, but they've already pre-approved themselves through you and they're in a conundrum. What do? How do you handle that situation? Why would it be good for them to get pre-approved with you if they know they're going to go out and maybe look at new construction? How do we resolve that?
Each builder is going to be different on who they use and how they set up their incentives. A lot of times those incentives are built into the rates or there's some kind of a program, but it's just basically having that extra checks and balance in place. Let me take a look at it, get an estimate from them. And again, I'll shoot you straight. If they're giving you a deal that I can't touch, I'll let you know up front. But if there's money being hidden in the interest rate or something else, or they're not doing the right program for you, then that's really the main thing, because a lot of your builder mortgage companies are not going to be experienced. They're working for a builder for a reason, and they're not going to get the most experienced loan officer out there. And so they're also looking for the cookie cutter type loans. And so if you're outside the box, if the builder declines you definitely want to call us, because there's a good chance we can get you approved.
And I can say, I just want to talk about an experience real quick. This was maybe a year and a half ago. We had a client who was fully speaking Spanish. Your staff got them well qualified, and they only had to bring about $23,000 to the closing table. That was down payment plus out of pocket. She ended up buying new construction, and they said, we'll give you another $5,000 or so if you will just use our lender. Their lender couldn't get it done. This is just an example of how these things can be done multiple ways, right? Their lender came back at the last minute, 3 weeks before we're supposed to close this new home, and it's months later because it got built, right? And said, no, you need $60,000 to close. And they canceled her contract because they said, you obviously, based on our lender, you don't have $60,000. So we had to call them and say, why would you do that without talking to us? She is pre-approved. She has the 20,000. Yeah, we can do this. And it took quite a bit of jumping up and down on the desk at the builder on our part, the realtor, and on your loan officer, the Spanish-speaking loan officer, to go, they put her with a lender who didn't speak Spanish. And one, and number two, he didn't know the program you guys knew. And this is a national big builder. So they finally came back and said, you can have the loan and you can get it done and we'll put you back in contract, but you must complete the loan. I think they gave us what, Tom, 2.5, 3 weeks, and which was really okay. And they got it done. She moved into that house, and it's just a success story that I could tell you a bunch of. And it just goes to show, not only is the realtor important, and I'm always saying that, the realtor you choose will dictate equity you get when you buy, how much money you pay, what the value of the dollars is, but the fact of whether you get to buy or not and how efficient it is all about, my friend, over here, Tom Pfister, and the lender that you pick. Two experts walking hand in hand down the road with you, making sure you don't get off the path, or at least advising you. You can do what you want, as people do, right, Tom? But that's just how important this is. And Tom, I just want to say thanks for being here today. We've spent a lot of time talking about this. You have rolled out, again, just some golden nuggets that I hope people were taking notes, because this video alone, just this conversation, you've put out there things that I can't tell you the heartache you'll save yourself just by being with an expert lender. And so with that, I'll include down below in the comments as well. We'll put Tom's contact information again. And hopefully, if you guys, anything you hear here sounds interesting, if you'd like to have a chat, go ahead and schedule a Zoom call right down below. We'd love to talk with you and learn about what your needs are, what your wants are, what you desire in a living experience, and possibly a home that's in one of the towns or communities north of Dallas, Texas. We'd love to do it and help you move with confidence. Hope you have a great day. We'll talk soon.